The world of high-stakes finance has just witnessed one of the most calculated psychological operations in market history. Within the span of a single trading week, the gold and silver markets experienced a historic, record-breaking drop that wiped out over $5.5 trillion in market capitalization. To the average retail investor, it looked like the end of the precious metals bull run. Headlines across the globe flashed red, calling it a total collapse, a burst bubble, and a return to the era of the dominant dollar. But while the masses were panicking and liquidating their positions in fear, the smart money, the institutional giants, and the central bank algorithms were waiting for one specific, undeniable technical signal. This wasn't just a random market correction. It was a massive, systematic reset designed to flush out the weak hands and prepare the stage for the next explosive leg up. Today, we are diving deep into the anatomy of this flash crash, the technical signal that triggered the massive rebound, and why the surge we are seeing right now is the most important movement in the 2026 financial landscape. To understand where we are going, we must first analyze the sheer scale of the carnage we just survived. The drop was nothing short of apocalyptic for leveraged traders. Gold, which had been in a parabolic rally throughout January, suddenly faced a wave of selling that saw prices plummet by nearly $1,000 per ounce in a matter of days. Silver followed suit, dropping with even higher volatility, as it often does. But what caused this? It wasn't just one thing. It was a perfect storm of macroeconomic and technical triggers. The first major catalyst was the political earthquake in Washington. The nomination of Kevin Warsh as the next Federal Reserve Chairman sent shockwaves through the currency markets. Warsh, known for his hawkish stance on inflation and his history with the Fed during the Great Financial Crisis, represents a shift toward a hard money approach. The immediate reaction was a massive spike in the US dollar index, or the DXY. As the dollar surged on the prospect of higher for longer interest rates and a more aggressive Fed gold, the dollar's primary rival, took a massive hit. However, the dollar's strength was only the trigger. The fuel for the crash came from the CME Group. In a move that many veteran traders viewed as a direct attack on the metals rally, the CME raised margin requirements for gold and silver futures multiple times in a single week. For those unfamiliar with how the futures market works, when margins are raised, traders are forced to put up more cash to hold their existing positions. If they don't have the liquidity on hand, their brokers automatically liquidate their holdings. This created a forced selling cascade. As the price dropped, more margin calls were triggered, which led to more selling, creating a self-fulfilling prophecy of downward momentum. By the time the dust settled, gold had seen its largest daily market cap swing in human history. The volatility was so extreme that it exceeded the market swing seen during the 2008 financial crisis and the 2020 lockdowns. But amidst this chaos, a very specific technical signal began to emerge on the long-term charts. While retail investors were watching the 1-minute and 5-minute candles in a state of terror, institutional algorithms were focused on the 50-day moving average. In any healthy bull market, prices cannot go up in a straight line forever. They become overextended or overbought. Before the crash, gold's relative strength index, or RSI, had reached a staggering level of 90. To put that in perspective, anything above 70 is considered overbought. A reading of 90 is extreme froth. The market was screaming for a reset. This crash provided exactly that. It was a violent, rapid return to the mean. The critical moment arrived when gold touched the $4,480 level. This wasn't a random number. This was the precise location of the 50-day moving average, a level that has acted as the line in the sand for institutional buyers for decades. As soon as the price entered the zone between 4,400 and 4,480, the selling pressure vanished. It was replaced by a wall of buying orders. This is the technical signal that the headlines are now finally starting to report. The 50-day moving average held firm. It was tested, it was challenged, and it stood its ground. This confirmed to the entire world that the primary uptrend of 2026 is not only alive, but has been strengthened by this purge. Silver's recovery was even more telling. Silver is often referred to as the restless metal because of its dual role as both a financial asset and an industrial powerhouse. When gold dropped, silver fell harder, as is its nature. But as gold found support at its 50-day average, silver successfully tested its own key moving averages twice. The bounce in silver has been sharper and more aggressive, suggesting that industrial demand and a shortage of physical supply are now overriding the paper market manipulation. The RSI for both metals has now reset to neutral levels. The froth has been removed, the speculative excess has been purged, and the market is now on a much more sustainable foundation. Now, we have to look at the global perspective, because what's happening in the United States is only one half of the story. While the US markets were liquidating paper contracts, the physical markets in the East were doing the exact opposite. Reports from the Shanghai Gold Exchange and the bullion markets in India suggest that as prices dipped, physical demand skyrocketed. Central banks, particularly those in the BRICS nations, viewed this record drop as a gift. They are currently in the middle of a multi-year plan to diversify away from the US dollar, and a $1,000 discount on gold is exactly what they needed to accelerate their accumulation. We are seeing a massive migration of gold from the west to the east. While Western traders are selling paper gold on the COMEX, Eastern institutions are buying physical gold and moving it into private vaults. This creates a supply-demand imbalance that will eventually lead to a massive short squeeze in the paper markets. The big banks are also shifting their tone. Goldman Sachs, which has been one of the most vocal bulls in this cycle, has refused to lower its price targets. They are maintaining a $5,400 target for gold, citing the unprecedented level of central bank demand. UBS has gone even further, raising their mid-year forecast to $6,200. These aren't just guesses. These are projections based on the reality of the U.S. national debt. As we move further into 2026, the interest payments on the U.S. debt are reaching a level where they are consuming a massive portion of the federal budget. This is the debt spiral that macroeconomists have warned about for years. In this environment, the Federal Reserve has very few options. If they keep rates high to fight inflation, they risk a collapse of the banking system and an inability to service the debt. If they cut rates to save the economy, they risk hyperinflation and the total debasement of the dollar. In either scenario, gold and silver win. This brings us to the most important realization for investors today. The record drop was not a sign of weakness, it was a sign of a maturing bull market. In every major gold cycle in history, there has been a moment of extreme volatility that shakes out everyone who isn't prepared for the long haul. We saw it in the 1970s, and we saw it in the early 2000s. These flash crashes are the points of maximum opportunity. The technical signal we just received, the bounce off the 50-day moving average, is the market's way of saying that the floor is set. The new support levels have been established, and they are significantly higher than anyone thought possible just a year ago. As we look ahead to the rest of 2026, the volatility is not going to disappear. In fact, it will likely increase. We are in a period of intense geopolitical shifting. The conflict in the Middle East remains a wild card, the trade tensions between the US and China are reaching a boiling point, and the internal political divisions within the United States are creating an atmosphere of uncertainty. Historically, gold is the only asset that thrives on uncertainty. It is the only asset that is not someone else's liability. When you hold physical gold or silver, you are holding the only form of money that has never failed in over 5,000 years. The surge we are seeing right now is just the beginning of the next phase. If the patterns of the past are any indication, the recovery from a 50-day moving average test usually leads to a new all-time high within weeks. The shorts are being squeezed, the margin sellers are out of the way, and the path of least resistance is now higher. The technical trap has been sprung, and those who were brave enough to buy the dip are already seeing significant gains. But for those who are still waiting on the sidelines, the window of opportunity is closing. The market has proven its resilience, and the signal is clear. In conclusion, the events of the last few days have been a masterclass in market psychology. We saw a record-breaking drop designed to create panic, followed by a textbook technical rebound that confirmed the strength of the underlying trend. We saw the influence of the Federal Reserve and the CME, but more importantly, we saw the overwhelming power of global demand. Whether you are a short-term trader or a long-term stacker, the message is the same. The fundamentals for precious metals have never been stronger. The debt is too high, the geopolitical risks are too great, and the supply of physical metal is too low for this bull market to end here. The flash crash was the reset the market needed to reach the next level. We have cleared the 50-day average, we have reset the RSI, and we have confirmed the support of the world's largest financial institutions. The surge is real, the signal is verified, and the next chapter of the great 2026 gold and silver rally is currently being written. Stay focused on the data, ignore the noise of the headlines, and remember that in a world of unlimited paper currency, the only true protection is the enduring value of gold and silver. This is a journey of wealth preservation in an era of unprecedented change. Make sure you are positioned on the right side of history. The market has given us its signal. Now the rest is up to you. Thank you for watching this deep dive into the 2026 metals market. If you found this analysis valuable, ensure you are subscribed for more in-depth financial reports and market updates. The economic landscape is changing faster than ever, and staying informed is your greatest asset. We will see you in the next update as we continue to track the collapse of the old financial order and the rise of the new era of hard assets. Don't let the volatility distract you from the destination. The surge has started, and the best is yet to come.